Welcome to Sorcery's podcast. I'm Molly O'Shea, the founder of Sorcery, a weekly top VC deals and tech trends newsletter. We highlight the top GPs, founders, and deal announcements leading the next innovation cycle. Today, I'm very excited. We have David Weisburd, co-founder and head of venture capital at 10x Capital. He's also known for being a very good host on the 10x Capital podcast, as well as host on Liquidity, a spinoff of Jason Calacanis's This Week in Startups. He focuses a lot on LP and GP conversations. I hope you enjoy. Welcome, David. I'm so excited to have you on today. Thank you for joining the pod.
I'm very excited, Molly. Thank you for inviting me.
Well, to begin, you started 10x Capital over 5 years now. For context, how did it all begin? What's the investment strategy, and what are your areas of focus and stages?
Absolutely. So just to clarify, I joined roughly 5 years ago. So I actually joined to run and to build out the venture franchise. Hans Thomas, I had known him for several years before I joined. We had met up at several family office conferences, and we talked about, what would it look like for 10x to have a venture franchise, and built that over now, 5.5 years. But about a couple of years ago, Hans takes me out to dinner, and we have a nice dinner, and then he whips out a business card and he says, "This is your new business card." So he retroactively made me a co-founder, which was very nice. Not something that we negotiated or ever discussed or ever really crossed my mind. So I'm the co-founder by title, but we've had a great run, and it's been a pleasure to work with Hans, and we built some interesting stuff at 10x.
Great. And so you're doing venture capital. More recently, I've been seeing your name and your face pop up on plenty of podcasts. So you have one with Jason Calacanis for This Week in Startups, and you're also doing one with Eric Torenberg at Turpentine. So how did this VC route transfer into podcasting?
Yeah, it's great. I'm ad retargeting you, so I might not be on as many podcasts as you might think, but appreciate the kind words. First with Eric. So as you know, Eric started a network called Turpentine, and for many years, people had told me to do a podcast. I didn't want to do a podcast because I think it's, I'm big on coming up with creative, differentiated strategies. I didn't think at its face doing a podcast was anything too clever or too unique. But me and Eric had a 3.5-hour dinner at my place in Miami. I think it was the beginning of last year. And he basically said, we basically both decided that it would have been a good podcast, our conversation. Just we weren't recording. And then he basically said, would you like to start a podcast together? And because of Eric and because of his incredible media reach and his reputation and all those things, I actually gave it a serious thought. And I came back and I said, what if we start a podcast interviewing limited partners and focusing on the very opaque world of limited partners? Limited partners control our biggest part of the venture ecosystem, and the venture ecosystem in many ways creates the future of humanity. So it's an important part of the world for how little coverage it gets. And special shout out to individuals like Beezer Clarkson, Chris Duvos, who started the Open LP movement and have been bringing a lot of transparency to the space. So I thought, what if we started a podcast exclusively focused on limited partners and VCs? It's like the smallest niche of all time. And somehow, 40 plus episodes later, it's become a success in terms of, at least in the ecosystem. In terms of Jason Calacanis, he was a guest on what's now called the 10x Capital podcast, which is my podcast. We had a good rapport. Jason is one of the most entertaining humans on the planet. He really is, I believe, the world's greatest moderator. He was looking to co-host a new show, and I reached out and I said, look, I know I'm not the most famous person in the ecosystem, but he knew how hard I worked. And he also knew that I had all these limited partners coming out of the woodwork to jump on my podcast. So we decided to collaborate on a podcast in a segment called Liquidity, a 4-person panel talking with the latest GP and LP on everything on this week's events and startups. So it's kind of a return to Jason's a kind of core philosophy. But that we've been collaborating on that, and by the time this comes out, it'll probably hopefully be 10 plus episodes.
Wow, that's pretty incredible. I spent some time in the LP world when I was at a corporate venture fund. I do know that all different types of LPs exist amongst institutional family offices, and multi-stage strategies. So it's great that you're bringing light to that, and you've done over 40 episodes. I'm curious, between working with Jason and yourself getting more experienced in podcasts, what are the secrets?
What are the secret sauces? Yeah. Nice thing about podcasts is you get to extract the best practices from everybody. There's a couple of things. So one of the keys to being a better podcaster, just like with any skill, is to continue doing it. You do something 30, 40 times, you're going to get better at it. I don't even think one should even judge their skill set until episode 10. That there's nothing more cringe than seeing yourself on camera. And what you're really experiencing from a psychological standpoint is the delta between how you perceive yourself and what you actually are. One of the first things that happens when you do a lot of podcasts, you start to really appreciate individuals like Jason Calacanis and how good they actually are. When I jumped on my first podcast with Jason, I was like, holy crap. The delta was so high, but I also got excited because I'm like, look, if I learn, if I become better, there's a lot more room for improvement. So the first thing that I would tell you is just repetition. I've been doing 2 podcasts a week now, I think for about 10 to 15 weeks, which of course, not every podcast makes it. And I also do Jason's podcast. So I do a minimum of 3 podcasts a week, but really it's about 5 or 6 a week. So the second aspect is active listening. I had a podcast earlier today. We were just talking about how listening is one of those evolutionary skills that is learned. Human beings and Homo sapiens are not naturally good listeners. And most people, just like they think they look really good on camera, they think they're good listeners. And neither are true. They look bad
Yeah.
and they're poor listeners. Almost all my relationships that come on the podcast have been existing guests or 1 degree removed. Existing relationships or 1 degree removed. So it's hard to become a podcaster straight when you enter an industry. There is an incumbent advantage from that. Ted Seides, who runs Capital Allocators, one of the OG private equity podcasts, he actually told me that still to this day, over a decade after he started that, a lot of the guests are still his personal relationships they had for many decades. Building your in real life network is very critical to being a good podcaster as well.
Consistency is very important, especially with Sorcery and the newsletter. But it's curious. I'd like to think, being in VC for this long, and I'm sure you might have the same experience, we're on video calls all the time. We're constantly talking to people. It's almost like a sales role. Like, I've probably had hundreds, if not thousands, of video calls with people or meetings, but having this like kind of external viewpoint of now looking back at the conversation and seeing if it was actually good, if it was thoughtful, that's the challenging point. But hopefully they get better.
That's such a good point. Actually, repetition is not enough. Repetition, recording, and also feedback. Recording yourself is really critical. Just jumping on Zoom calls doesn't actually help, because the way we improve ourselves is by seeing kind of discrepancy in skill and changing a behavior. If you're not changing the behavior, you're just repeating the same thing over and over.
You're in the venture capital unit of your fund. You're exposed to different asset classes within that fund. You're doing an LP podcast yourself. So from the early to the late stage public market investments, what have been your biggest learnings, I guess, high level over the last couple of years?
Venture capital specifically, I only want to speak to that. We do real estate, private credit, biotech, all sorts of stuff. One thing that is probably the most foundational part about the venture capital ecosystem is venture capital is truly an access class, not an asset class. I had on my podcast Lindell Ekman from Foundry, and he was at UTIMCO. He got a really interesting kind of purview into a $70 billion endowment. And I asked him straight up on my podcast, is venture capital the world's greatest asset class, right? At UTIMCO, at University of Texas, he got to look at everything under the roof, right? Not only is it $70 billion, it's also an endowment, which is very sexy for LPs. And he unequivocally said yes. The answer is yes, without even taking into consideration tax savings from being in the venture asset class, which makes it even more attractive. But venture capital is also the worst asset class on the planet as well. There's not many funds where you could invest and you could lose money or lose like half your money. So venture capital is all about getting into that top quartile and getting into those top opportunities. And there's ways to do that, and there's ways not to do that. And that, I think, is an underreported part of the.
Yeah, we are in the midst of probably I don't know, the most confusing parts of the cycle where you're getting a lot of positive signals and you're also getting a lot of really negative signals, and it's very unpredictable. There are components that are accelerating things really quick, like AI and just coming out of COVID restructurings, right? Like we're kind of optimizing our business stacks. We're creating more efficient businesses, getting more fit, as some investors like to call it. So there's a lot of movements going on, and it's hard to know which signals are going up and going down. But I'm curious, from your perspective, what are you most excited about? What are you spending your time on?
One thing that every great investor, LP, and GP will tell you is that we don't try to be macro investors. So you really want to be time diversified in the asset class. If you look at a lot of high net worth individuals, not family offices, they literally come in at the height of the market. They were super bullish in 2021, and then they leave, 2023, 2024, which I believe will be some of the largest vintages. So, absent of coming in when things are difficult and coming out when things are good, which is very difficult to do, one key thing is to always be in the market, always be time diversified. And there's a very actionable way to do that, which is you make sure you invest in 6 to 7 year increments. So you're putting in a sixth of your money every year to make sure that you're time diversified. The nice thing about venture capital funds is they typically, although they technically have 5-year investment periods, they're typically deployed 2 to 3 years. So you already have some time diversification versus investing in a single startup. So the first aspect that I would say is time diversification is very key. The more volatile a time period, the more time diversification is key. Second aspect I would advise is a stage diversification. Early, mid stage, late stage. Some would argue right now late stage is a terrible place to invest. I just saw an article, Mamoon and Ilya from Kleiner said that more than 80% of the opportunities they see are AI. If you go back 15 years ago, technology used to be a sector. Now everything's like in technology. Even oil and gas investments that we make have a technological aspect. Real estate has technology. So technology has almost become a catch-all for anything innovative. There may be a future where AI is the same thing, where nobody in 5 years will say I invest in AI, just like somebody won't say I invest in tech, just seen as the entire industry.
I'd love to hear your positioning as a GP.
As a GP, we're hired to generate alpha, right? So our LPs are endowments, fund of funds. We're talking to some sovereigns, hopefully for the next fund. So they're not looking for you to be hyper diversified. Similarly to like a VC, they want you like to put all your money on red 5 times over and over because they want the power law outcomes. Now the entrepreneur's like, look, my company's worth 150 million. I have 40% of the company. I'd rather keep my 60 million than put it on red and try to get 600 million, right? So there's this misalignment between founder and GP. And there's slightly less of a misalignment. So a lot of top LPs in the world, they want their founders to actually have a concentrated portfolio because the theory is, first of all, the marginal diversification past 15 positions. There's a lot of academic research on it. I took an entire class in business school by Ken French, and one of the entire classes was the myth of diversification. Essentially, money managers sell diversification as a way to increase their own importance and also to increase fees, some would argue. We want to take big, bold bets in a small amount of companies, especially when it comes to follow-ons. So it depends on which pool of capital, but all things being equal, do you want to be aggressive? Now, do you want to be aggressive like Brian Singerman at Founders Fund? He went on Jason's podcast. He puts in every fund, Founders Fund, I think puts up to 25%. Somebody could correct me, but up to 25% in a single position. They've done that with SpaceX, Airbnb, all these, iconic companies. That's one way to do it, and their LPs back them. That's also a way to maybe not build a franchise if you're unlucky. So it's tricky. It might be the theoretically correct thing to do, but also the inefficient thing to do for the GP. But all things being equal, our LPs want us to generate alpha, and that's what we try to do.
I'm curious, given your perspective, having talked to many LPs and being an active GP, what do you identify as AI if it's becoming a blanket statement for technology in general? Do you think it's going to be broken down back into its subcategories and verticals? Or do you think that it's going to just be a natural part of the technology stack? Like, at what point does this term kind of fade away? Is it when NVIDIA's stock goes down or
Yeah.
when Google fixes their GPT?
If you look back historically, I think VCs are the ultimate narrative dealers. And, they always were correct about every fad being a fad and every, trend being a trend. But essentially, it's the same thing. It's depends on whether it works or not. Like, for example, mobile, social were trends. AR, VR at the time, at least, were a fad. Some would say like crypto and Web 3.0 was a fad. That one's a little bit TBD. So if you look historically, venture capital and GPs actually have an incredibly high rate of getting trends, and that's roughly 50%. So you'd say, how's 50% a good track record? Well, if you return funds of 10, 15x, and then if it is a fad, you return 1.52x, that's a bet that most endowments would want to go into. So first of all, it's important to understand why something could be hot, even if people aren't aware of how it might end up, right? The asymmetry. We talk about power laws. It's probably the most hyped word in venture capital, but it's really critical, right? One of those companies will be the next Google, so you want to be in the basket. If you even look at the .com, right? So .com was obviously a hype. That's why it's rational to invest into AI versus in other cases, sometimes it could be the hype cycles, right? You have peak 2021, people were investing into companies that had 100, 200, 500x ARR, right? I would argue probably if you build a basket of that, there's no power laws there. Power laws pretty much end at about $100 million valuation, right? Depending on obviously like whether stuff will expand. You can't invest at a $500 million valuation, get 1,000x. Just the math doesn't work. In terms of AI specifically, I think my thesis is that it's going to be multiple stages of AI development. So first, it seems like we're in the infrastructure phase where you have OpenAI and Anthropic, which we're investor in, and other Google, Facebook's going with the open source. So you have kind of the picks and shovels stage of the business today. You look at crypto similarly, kind of the Coinbase, and dare I say FTX, but the whole picks and shovels aspect of that. And then you will have, and you've already had the verticalization, whether it's like legal AI, healthcare AI. So you're going to have some big winners there as well. One thing that people are trying to figure out, and people are spending a lot of money believing that LLMs and the language models themselves will not be commoditized, is investing into those spaces. And then you have obviously Sam Altman. We're very proud to be in the first round, I believe, or very early in WorldCoin, one of his other AI companies, and he's figured this out. He's always 1 to 2 steps ahead of everything, and he's figured out that once you build out the LLM, you have to somehow make sure that you're not decommoditized. So he's essentially working on the Apple on the App Store for AI. We'll see what happens, but I think you do want to, as an investor, you want to get exposure to a couple different companies, best of class companies in these different spaces.
It's been really fun to see all of this evolve so quickly and to see even partnerships and applications emerge between the companies, whether it's like Rabbit and Anthropic or Perplexity. And Perplexity is now doing lots of partnerships with many people and starting to deploy their search model. If we're talking about alpha, does alpha really exist in VC? Where do we find alpha?
Yeah, that's one of my favorite questions. So yes, extreme alpha exists in VC, but it also extreme dilution of alpha exists in VCs. Without saying specific funds, if you look at some of the best funds in the world, one way that I look at it is stage. I think if you look at their seed and Series A, if you just carve that out and put it into portfolio, I think they would be perennially a 10, 15, 20x. In fact, one of the things in venture, it's a little bit confusing because you have a lot of scale benefits and scale disadvantages. One of the biggest scale benefits is brand and reputation, all these things. Obviously, the main scale drawback is the dilution of alpha. So if you look at seed and Series A, I think these funds would be returning 20, and I think once in a while they would return a 50x. You only have to look as far as benchmark to see what returns are possible for platforms that do not scale. So there's a lot of alpha, but there's also a lot of beta in terms of later stage investing, which isn't necessarily bad. Perhaps that portfolio is a 2x. Perhaps it's a 1.75x. Totally good portfolio. One of the paradoxes of asset management is that as your fund scales, you actually become more attractive to the majority of capital in the market. It's not the majority of LPs, but the majority of capital. And you start to get phone calls from people like CalPERS. Our chief investment officer was former chief investment officer of CalPERS, which is a very difficult job. He's also former chief investment of Alaska Permanent Fund, which has $60 billion. And they have to write large checks. And they have concentration limits, sometimes regulatory, sometimes structural. So now when you're a $5 billion venture fund, for the first time, it makes sense for CalPERS to do due diligence on you. Now I'm just kind of picking on CalPERS, but let's say XYZ sovereign wealth fund who wants to deploy $500 million into a fund. Now it actually makes sense for them to talk to you. So there are actually scale efficiencies. The old adage is nobody gets fired for hiring IBM. Same thing happens in the LP world. So there's a lot of downside. There's not a lot of upside.
Being at a corporate venture fund where we did have positions, I got exposure into the LP world a little bit more. And I got to see how sometimes people make relationship bets and they just continue on with certain funds based on relationships versus, let's say, like performance or check sizes.
There's a systematic bias. I could take a guess on why that is, but there's a huge systematic bias to re-up. We could unpack that if you like.
I want to unpack that. Let's unpack that.
Okay. This is me going into mind reading. I think one systematic bias is just once you've done. So there's a couple of things. There is a rational reason. So Molly, congrats, you've spun off. You're doing a $75 million solo GP fund. I'm going to spend 40, 50 hours. If you ask people like Michael Kim from Sindana or Beezer Clarkson from Sapphire, they're doing like 10, 15 manager references. They're really going deep. So once they really get a sense, once they get conviction to anything, it would make no sense for them not to back you for fund two because no market data has changed. Unless you do something like go completely off strategy or unless you and your partner, break up the partnership, it doesn't make sense for them to re-up. That's the rational thing. The question becomes, why are you still with those managers in fund four? And this is a question and why are you automatically re-upping? It's easy to reback the same managers. Obviously, there's relationships. So those are some of the factors. There's a lot of incremental work to onboarding new managers.
So you re-up based on relationships. What if the returns aren't that great? Like, how do you make that case internally? Maybe there are some good brand names in the fund, but the assets don't look that great.
So this goes back to VCs being great narrative dealers. So you have to be very good at looking at things empirically. What's kind of crazy about VC is that you don't really know till fund four. Why is that? Because you typically are raising in 2-3 year increments. So you don't really know. You don't really have DPI until, let's say, fund three. So you don't know. You don't actually have the returns data. Now you have some leading indicators. A lot of people say, you don't know until year 15 whether you're good at VC. That's complete idiotic because you obviously have people marking you up. Once you get to Series B, you could sell via secondary. So whether or not you choose to sell does not mean that asset isn't worth anything. It's a framework that people say, which is important to understand because it takes a long time, but taken literally, it's nonsensical. But when you're on your fund 3-4 years, you really don't know. So you don't actually know whether to re-up. And then, it all depends how much conviction. So one thing that LPs will not tell you, and they may not even be aware of, is that they actually have a hierarchy of their managers. They have some automatic commits. unless, there's like fraud. There's like tier 1A,
Yeah.
right? Like benchmark, like unless like my GP, commits fraud or kills somebody, I'm going to re-up to them. And then there's like also the exact opposite, which is, like he caught me on the best day of my life and like I got it in and like I immediately regretted it, or like 6 months later. And like, if like there's anything that shows me there's not returns, I'm going to replace him or her. There's a hierarchy there. And LPs are also being very sensitive towards DPI in this market. I have a contrarian view on that.
Why are you against DPI? It's a lovely
Yeah,
thing. Everyone should be distributing.
yeah, my IR will like murder me. No, DPI is a very, very, very good thing. The problem with DPI is that it is a lagging indicator. So it shows how good, Molly, going back to your $75 million fund one, you won't have DPI until 2034, really, maybe 2033. So that means you are a good VC in 2024. What happens between 2024 and 2033? What happens there? Many different things happen. The industry changes. People get fat and lazy in terms of like motivation. People get rich. The people get addicted to management fees and don't care as much about the carry. Partnerships break up. People move. I just saw like a famous unicorn founder, like they forced him to come back to San Francisco. He had raised like at a $5 billion valuation. They're like, you have to go back into office, right? So stuff like that happens. So a lot of things that happen that would technically, you had a great, congrats, Molly. Like you have a 7x return on your fund one, top 1%. That doesn't mean that now your 2034 vintage is going to be good. So I think DPI is important. And DPI is kind of like ground truth. Like it's an equalizer. You could be the worst marketer in the world, but eventually like your DPI will catch up, right? So it is a great equalizer. It's the most empirical fact, but it is a highly lagging indicator. And I don't hear many people talking about that. And I think that's an important thing for people to realize.
On your recent podcast, you had Mark Suster of Upfront Ventures. I'm obviously a big fan. I'm an alumni. I love Upfront. He had a really good perspective on this, and he had a proactive approach with that fund. And when he decided to sell some positions and go after some, can people be more proactive with trying to find DPI, their secondary funds, their secondary kind of strategies to sell off assets? How much of that does that matter?
That's a very, very good point and very good distinction. You can be proactive about your DPI. It just takes humility. And also it's a form of conservatism. We sold a lot of stuff in 2021. We didn't time the market perfectly, but we did sell a lot just because we thought pricing were crazy. A good thought exercise that I do in order to decide whether I want to sell, especially once a position is up, is do I want to invest more? Would I reinvest at this stage? Another way to look at it is a cost of capital. I'm going to pick on SoftBank a little bit. But as a general rule, when SoftBank would invest in one of my companies, I would sell my position or a lot of the position. Why is that? It's not because SoftBank is, I have anything against SoftBank. There's two reasons. One is they were buying my pre-seed and seed liquidation pref equity at like Series G pricing. So they were basically buying my common shares. If you look at what that is, when your shares have gone up 50 times, 98% of your shares are common essentially because they're protected, and 2% are protected. So they would be buying my common shares at the preferred price. I think you almost have to sell. Second aspect, and this is the real aspect, is my investors are not underwriting for an 8% return. SoftBank investors are implicitly. So unless this is like top quartile in the SoftBank portfolio, I should expect to get an 8% return from there on. So maybe I get that 8%, and there is somewhat of a corruption by VCs of holding because they get paid on the carry. Despite what I just said, I do care about DPI and I care about returning IRR and all these things. So I want to actually return the capital quicker to investors. So those are like obvious sales. And I think every GP should answer the question, why didn't you sell in the SoftBank round? Especially because SoftBank had such a big secondary component. I could account for that. You could ask other people on the podcast why you didn't sell. And then you have this whole situation where let's say your position might be up 50 or 100x. So let's give some numbers. You invest $2 million, your position is worth 40 million or 100 million. I think it does make sense to sell 10, 20%. I think you should, quote unquote, should. people get really into this whole thing like, should I keep it in or should I sell? I think you sell 10, 15, 20%. A lot of LGPs get short-term greedy. They're like, well, I wanted to let it ride and get more carry. Well, first of all, it could go down to zero. But secondly, if they're really thinking, strategically, that DPI will help them raise their next fund. So it'll help them keep the music going, keep kind of the fund fees coming in. So it is highly rational to do that as well.
Is there a point at which you look at these assets and you're like, oh, well, this looks like a rational exit window. Let's start to sell it now. It might not become $20 billion when it IPOs, or it might not become like $5 billion when it IPOs. But looking across our portfolio, $500 million, $750 million, that looks pretty good. Is that when you would be considering this kind of strategy, or would it be mostly multiples based?
You mean valuation versus multiples based? I think you have to do both. So if you think something could only be worth 1.5 billion and it's at a billion and there's a lot of risk, I think you have to sell all of it if that's really your analysis, right? I'm talking about something's at 500 million, has 10x more potential. I think you sell 20% of it at that point just to return. And one of the things that people don't think about is, what is your LP base and what do they want? Your LPs are your customers. Maybe, and this is rare, but maybe your family offices want you to get, a 12% return predictably, and maybe that means that you keep it in if it's growing at 20%. So it also depends on the LP base. Typically, you are the riskiest part of your bucket. I had Chris Presti, has a very long last name. He manages 3% of $140 billion state of Wisconsin investment board, right? So he's paid to take risks. So if I was to deliver an 8% to him, that would not be the point of that asset class in his portfolio, even if his entire portfolio is made to return 7-8%. So I think it really depends on your LP base as well.
To go back to the very start of this amazing asset class of VC, the early stage companies that are out right now, the market is very turbulent. What kind of advice do you have for those founders that maybe fundraised in the last year and now they're, a little bit confused, or are having that OpenAI identity crisis?
Ultimately, you have to look at the world as probabilistic. I think people look back at PayPal, sold for, I believe, a billion, somewhere between $1 billion and $1.5 billion, and everyone's like, oh, you sold too early, or 500 billion. Well, look at what those founders have gone on to do, right? Elon Musk, Peter Thiel, David Sachs, Roloff, who runs Sequoia. So you have to look at things probabilistically. And at that point, there was huge risks. There was all this fraud stuff. There's the eBay relationship. There's a lot of things that could go wrong. So you have to look at that probabilistically. Is the probability of OpenAI disrupting my business 90% or is it 20%? One is, I think, acceptable and one is not acceptable, unless that 10% chance, the expected value of that is $1 trillion, right? People use these kind of heuristics, which is like, never worry about Google disrupting your business. Never worry about OpenAI. That's fine as a general rule, because most people are more cautious than they should be. But sometimes you should worry about that. And sometimes you should get more data points. One of the things that kind of we do as with institutional investors and some of our other pockets is we don't try to make decisions out of a vacuum. We have many different conversations. Ultimately, OpenAI is not going to go after, $1 trillion companies or $100 billion companies don't go after small segments. So it's unlikely that they'll purposely try to kill you, but maybe it's like the paperclip issue where they accidentally kill you, which I think is possible. But you should get more information, talk to people. Once you figure out, okay, there's a 30% chance OpenAI disrupts us and a 70% chance will be a $200 million company, then you could decide whether you want to move forward.
Great. And then on the other side, what advice do you have for GPs?
My LPs expect from me to deliver alpha. So you have to be more bold within a construct. Bold is a relative thing. When I was an entrepreneur, I had an N equals 1. That is bold. Having a portfolio of 10 companies is not as bold. I don't actually recommend 10. I think 15 is a good number. At the early stage, you could do more because the returns are so much bigger, right? A single return could return the entire fund. There's also a philosophical trade-off, or there's a financial trade-off that a lot of people don't implicitly talk about, which is size of portfolio and expected value of a portfolio. if you have a portfolio of 25 in your, let's say, $10 million solo GP, the odds of you being a 3x fund are high if you're competent. The odds of you being a 20x fund are low. So what are you gunning for? Are you gunning for pure alpha, or are you gunning for a 3 to 5x return and building another fund? There's this implicit trade-off that a lot of people don't either talk about nor think about.
Interesting. Yeah. I haven't gone out to raise my fund yet. So I haven't
I'd
thought
love
about
to anchor
that
your fund,
trade-off.
Molly. I'm just kind of inceptioning to anchor your funds.
Thank you. I appreciate that. It's good to know that I can have an anchor already. If you aren't already a follower or subscriber of David's podcasts, I'll link them. They'll be below. So thank you so much.
Great. Thank you, Molly. It's a pleasure, and hope to see you soon.
All right. See ya.